Global markets faced a Warsh shock on Friday, with gold and silver posting their biggest single-day drops in decades as the dollar surged. With former Fed Governor Kevin Warsh emerging as a top contender for the next chair, Wall Street is deeply confused by the candidate known as an inflation hawk, who now calls for faster rate cuts but insists on shrinking the Fed's balance sheet. Which Kevin Warsh is the real one? The market fears liquidity tightening from his balance sheet stance, yet hopes for his market savvy and commitment to central bank independence. Friday saw Wall Street grapple with a brutal repricing of assets. Spot silver plunged more than 35% intraday, its worst drop on record. Gold tumbled as much as 11%, suffering its worst single-day decline since January 1980. Meanwhile, the dollar index jumped 0.9%, and the yield on the 10-year U.S. Treasury note rose to 4.24%. The S&P 500 dipped 0.4%, while the more liquidity-sensitive Russell 2000 small-cap index fell 1.5%. At the heart of this chain reaction are Warsh's seemingly contradictory policy views, calling for the Fed to cut rates faster while adamantly pushing to shrink its massive balance sheet. The market is reacting to his balance sheet comments, and that will be a huge shock for risk assets, said Priya Misra, fixed income portfolio manager at J.P. Morgan Asset Management. For markets, rate cuts are a positive, but aggressive balance sheet reduction drains liquidity at the same time. This explains Friday's paradox where both safe haven assets, gold, treasuries, and risk assets sold off, leaving the dollar as the sole winner. Wall Street's biggest fear is Warsh's perceived hardline stance on the Fed's balance sheet. During his tenure as a Fed governor from 2006 to 2011, Warsh was known as an inflation hawk, long arguing that low rates and large-scale asset purchases fueled price pressures. While his recent pivot to faster cuts is noted, his steadfastness on shrinking the balance sheet worries investors that it would dilute the stimulus of any rate cuts. With the Fed having just restarted buying short-term bills to expand its balance sheet and ease overnight funding pressures, a reversal under Warsh would severely test market liquidity. Despite the market's sell-off verdict, top Wall Street circles aren't uniformly bearish. Many veteran investors see his core value as independence. Compared to a dovish flag-bearer desired by President Trump, Warsh is viewed as someone who can resist political pressure and uphold the Fed's independence. Rob Arnott, founder of Research Affiliates, called Warsh a pragmatist whose reasonable voice would soothe markets. Hedge fund legend Paul Tudor Jones praised his enormous market acumen, arguing Warsh is the best person to guide markets through challenges with U.S. debt over 100% of GDP and a 6% deficit. Dan Ivison, Group CIO at PIMCO, reassured markets that investors would adjust and Warsh would show sufficient independence. From a trading perspective, Friday's action also signaled a reversal of the currency debasement trade. Gold and silver's prior record highs reflected a loss of faith in the dollar and U.S. assets. Warsh's emergence flipped that script. The dollar's sharp rebound alongside the precious metals crash suggests investors are taking back their vote of no confidence in the greenback. Peter Bookvar, CIO of Bleakley Financial Group, captured the uncertainty with a quip. Will the real Kevin Warsh please stand up? All of the current market volatility is essentially a bet on the real Warsh policy stance. His position is complex and hard to pin down. A former staunch inflation hawk, recently turned rate cut advocate, yet perpetually focused on balance sheet reduction. No simple dove or hawk label fits. It's worth noting that even if confirmed, Warsh couldn't set policy alone. While the Fed chair wields great influence, decisions are constrained by Federal Open Market Committee votes. Divisions are already present, evident this week when Trump-appointed governors Waller and Milan dissented, voting for a 25 basis point cut against the decision to hold rates steady. Some investors warn that if the U.S. sees a UK-style scenario, frequent policy splits between the central bank chief and the committee, it would heighten uncertainty and keep markets under pressure. Clearly, Wall Street needs more time to fully digest the complex signals from this potential new Fed chair.